Okay, so in today's video, what we're going to be looking at here is chapter 22. And here we're going to be looking at what's called performance measurement and responsibility accounting. So essentially trying to kind of build on what we've looked at in the last few chapters and figure out why some of these things might be happening, who is ultimately responsible for those items, and trying to figure out this type of information to the best of our ability. Now, what we'll notice here very quickly then is that we need to start by figuring out what on earth performance evaluation really is. So when we look at performance evaluation, what we'll notice is that this is necessary, particularly for my larger companies, because they will be much easier to manage if we can subdivide these organizations into much smaller areas. Typically, we might refer to these as divisions, segments, departments, but I'm sure you've heard some of this phrasing just throughout your day-to-day life as you are at work, as you are just involved in various areas. You will certainly be familiar with these terms already, very likely. Now, of course, what we notice then is that in decentralized organizations, decisions will be made by unit managers instead of by top management. So what we really like to see is a fairly decentralized organization where we allow the people closest to the problems to be the ones making the decisions on how to resolve those problems. If we have a very top-down driven organization, then they can be very slow to adapt to challenges and change, and we can actually see a lot of inefficiency occurring, even if we have really good top-level management. It just takes them so long to notice it often what is happening at the very bottom of the organization that if we would empower those lower level workers, maybe even down to those right down, those very low level unit managers or the actual employees at that level to start making some of those decisions, well, they can respond to the actual issues on the ground in a much more quick manner than we can from just the top down. So that's what we're trying to see here. So if we're looking at our performance evaluation, we typically look at this in three different brackets or three different buckets. So we'll have what are called cost center areas of our organizations. These will be evaluated on their success, of course, in controlling cost. We then have our profit center organizations or our profit center segments of our business. And what we will notice with our profit centers, of course, is that those will be looking at the actual profit in its entirety. I do apologize. It looks like the PowerPoint kind of jumped back on me for a second. So we'll be looking, of course, at how those areas actually go about generating profit, which means they will actually be looking not only at the cost side, but also the profit. So how are we doing on cost? How are we doing on revenue? And together, of course, that will create profit. And then we'll be looking at our investment centers, which typically get evaluated on the use of investment center assets to generate that income. So whenever we are looking at things like a cost center, this typically will be something like a manufacturing department in a manufacturing company. So the manufacturing department itself is not generating revenue, they're just producing the item. So they're a cost center. What I'm most concerned about in that area is how are we managing our costs? Because if we can manage our costs, then that sets up the rest of the organization to be able to actually generate profit because we have a much lower cost put into each one of these units. Now, a profit center, typically we might evaluate something like a product line in its entirety. So how did product 117 do? Right? Well, that product itself, when it is sold, will generate revenue, and the actual production of product 117 will incur cost. So we'll need to look at both sides. So how did we do on the cost side? How did we do on the sales side? And typically here we'll be evaluating these managers on their ability to actually generate that income that we're looking for. Now, we do have to be careful though, because typically if you're a profit center manager, you're not going to have the authority to actually make physical asset investment decisions. So I can't actually buy myself this large piece of machinery that we really need. That decision typically is made by someone a little bit higher up, and this is our investment centers. So our investment centers will work on generating revenue and incurring costs, but the manager is also responsible for the investments made for the operating assets. So what we'll notice here is typically this might be someone like your chief operating officer, and they might have the authority to actually decide, do we need a new building? Do I need a new office? Do I need a new facility to actually be able to generate this income? So these investment center managers will typically be evaluated on their use of those assets to generate income. And we'll notice some ratios later in the chapter that help us do this in a much more organized way. So very good. So that's kind of where we're starting this chapter out. And what we'll notice here is we want to look at what first is called controllable versus uncontrollable costs. Now, I do believe we saw a bit of a preview of this back in chapter 21, so we'll just rehash it here very quickly in 22. So we said that before, a cost is controllable if the manager has the power to determine or at least significantly affect the amount of that cost that is incurred. So what we'll notice here is if I'm the manager of a department, I should have some authority or some ability to influence the amount of supplies, for example, that are used in that department. But what I probably don't have authority over is the salary that I make myself. I'm not the one deciding how much to pay me. That is someone above me. So if my department is not being profitable, but it's because of my salary, then I should not be evaluated because of that negatively. I had no influence over what I'm actually being paid, right? Beyond you saying, for example, well, if you work really hard, maybe you can generate a higher salary, or if you don't work so hard, maybe you get less, or, I mean, there are some debates in areas like that. But at the end of the day, the ultimate decision on how much I get paid is being made by someone that is not me. So it would not be right to evaluate me on something that is beyond my control, and that is those uncontrollable costs. Now, typically what we're looking for here is what is called a responsibility accounting system, and this is what is called an accounting system that provides information relating to two main areas. So we're looking at relating to the responsibilities of the individual management, so that is one piece of this. And then, of course, we want to be able to evaluate managers, but notice the key here. This is not on all items. This is on only those controllable items. So this is why it's so important that we be able to distinguish a controllable cost from an uncontrollable cost. At the end of the period, I should only be evaluating my management team on the items that they could actually influence, so that they had the ability to control, at least to a large extent. Now, whenever we start coming into this next area, we'll notice that typically in organizations, we have many different levels of structure. So starting at the bottom then and working up, we might notice that I'm looking at my plant manager of my beverage department. They will typically make decisions in that one area, but that will then get fed up along with every other department's information, maybe to the vice president of that region of the organization. Well, that region will have somebody who's in charge, in this case, of the Western region. Anything happening in that area will now be that vice president's responsibility. Then that information along with the Eastern region will get fed up into my executive vice president of the US, who will then have information coming along from Europe and Asia, moving into the president's purview, and then, of course, up to the board of directors. So we notice then that as we start lower, we start getting much more detailed information. But you can imagine that if I'm moving from the very bottom level all the way up to the president of the company, they probably require different information. If I'm that plant manager of this one department of, for example, this one location, I probably need to know much more detailed information than the president needs to know, right? The president, in this case, will be looking at information summarized for each continent. So we're looking at Asia, the US, we're looking at Europe, we're looking at a much broader scale than we are looking at on one individual company or on one individual location within that company. So what we'll see then is that as we actually come through and look at some of these reports later, we'll notice that at different levels, I get different information. And I think that makes sense to us. And so we'll see here, of course, the amount of detail will vary according to the level in the organization. The department manager themselves will receive the very detailed reports, while the store manager typically receives summarized information from each department. Now, the good news here is if I'm the president of the organization and I start to look in and I say, okay, well, there's a problem. For example, if we look back with my US operations, can the president then access these lower level reports? Almost certainly, right? All of this exists. So once the president identifies that there's an issue in one area, they can then follow this back down and start to figure out where the problem is actually arising. And that is very good. But at the first glance, when the president is trying to make decisions, they need to be able to look at a broad scale. Okay, where are we doing well? Where are we having problems? And then investigate those problems. And so that's what this type of structure is going to help me do. So starting at the bottom and coming up, you'll notice that my plant manager of my beverage department is getting information on direct materials, direct labor, and overhead. Very detailed information. And I can almost guarantee you there's information even more detailed than this, describing exactly what those direct materials are, describing exactly how many hours and what that rate was for direct labor and what that overhead is based on. Right? We can almost certainly find even more detailed information than what we have here. But you'll notice that once we leave that plant manager of the beverage department and bump up a level to the vice president is just receiving information on the beverage department in total. They are not receiving all of these broken out pieces. They're just receiving this bottom line. That bottom line is now flowing up, and we can see that in this case, my beverage department was slightly over budget, and I might start to wonder what is happening here. But at a quick glance, my vice president of the Western region can tell, okay, in the insurance department, we're ahead of budget a little bit. In the service department, we're a little bit ahead of budget. In those two areas, I'm probably not that concerned. But as I start to look at my other areas, I might want to investigate my food department. I might want to investigate my salaries and my department managers to figure out what is happening here, but why do I have such large variances? Now, we'll notice then as I move from my vice president of my Western region up to my controllable costs, up to those US operations, what I'm noticing then is I'm no longer receiving this very detailed breakout. I'm simply receiving the totals for that Western region. So now we can come up and look that for my executive vice president, I can see my salaries and vice presidents, they stayed right on budget. My quality control costs slightly over budget. My office costs were actually under budget pretty good. And my Eastern region was way ahead of budget. But my Western region, in this case, is creating some problems for me. They're way over budget, and I need to know why. So now I can actually start to drill into this information by falling back down through this, and I can start to actually see where that is happening, and I can pretty quickly find that that is because of this food department in that Western region. So we can very quickly identify where these issues are occurring, and of course, if we continued moving up the line, then we would receive something similar to this bottom line for each of our continents, for Europe, the US, and Asia. Very good. Now, my next area then is to distinguish between direct expenses and indirect expenses. So direct expenses, of course, as we've been seeing all semester, these are costs that are traced directly to a department and are incurred for that department's notice, sole benefit. So only one department is receiving the benefit. Indirect expenses, however, are costs that are incurred for the joint benefit. So they cannot be traced to only one department. So if we start looking at things like indirect expenses, we might see wages and salaries, rent, utilities, advertising, depreciation, and we can see some common allocation bases. So hopefully we were getting fairly familiar with these allocation bases by now. So I'm not going to spend a lot of time here, but if you want to look those over, feel free to do so. But I'm going to go ahead and move on here to slide number 12. So here in slide number 12, we're going to start looking at our expense allocation general model. Now there are other ways to do this, and you'll certainly see those in something like cost accounting, which is the course that follows this one. But in this case, we're going to stick with the general model, and we're going to look here and see that our indirect and service department expenses will be allocated across departments that benefit from them. That makes sense to me. If multiple departments receive value for this, then that cost should be shared among those departments. Next, we'll try to establish a cause-effect relationship to allocate those expenses. So when this happens, this amount of cost is incurred. So we're looking for that cost driver here. And then we'll say, of course, if no cause and effect exists, we will allocate based on the approximate relative benefit each department receives. So it's a little bit more vague, but of course, that would be my last step. So if there's not a very good cause-effect relationship that I think would really do a good job describing this, then I can try to estimate the value of the services received for each department, and I'll assign that much cost. Now, of course, in this case, my allocated cost will equal my total cost to allocate times that percentage of the allocation base that was used. So if I need to allocate $10,000 and one of my departments used 10% of that resource, then $1,000, of course, would be spent on that department, and the remaining 90 would be split among the other departments. Very good. So in this case, we'll notice that we have service department costs that are, of course, shared, indirect expenses that support the activities of multiple production departments. So we see here, once again, our service departments and those allocation bases. So we see things like office expenses where we would allocate, of course, on the number of employees or sales in each department, personnel expenses, the number of employees in each department. And we can see some common items here. Purchasing costs, the dollar amount of purchases, or more commonly, perhaps, the number of POs or purchase orders that have actually been processed. And you can certainly see that. Now, in this case, we'll notice that Classic Jewelry pays its janitorial services $800 per month to clean the store. Management will allocate this cost to the 3 departments according to the floor space each occupies. And the reason this makes sense to me then is because if I occupy a larger area of the store, then it would certainly seem to make sense to me that I would indeed take longer to clean that area if I was the janitorial company. And so because of that, a larger percentage of the cost should go to the areas that are larger, or the departments that are larger, and a smaller percentage of the cost should be given to the areas of the company that take up less space. So let's see how this works. In this case, we've got a jewelry department, a watch repair, and a china and silver area. So what we are noticing then is that whenever I actually come in here and look at this, my jewelry department takes up 2,400 square feet of the total 4,000. Well, 2,400 divided by 4,000 is 60% of that area. So I'll need to assign 60% of my monthly janitorial cost to my jewelry department, following down 15% to watch repair and 25% to the china and silver departments. I'll then take those percentages times my $800 total cost. So this is my percentage of the allocation base used is a 60, 15, and 25, and that total cost to be allocated in this case is the $800. Now you'll notice whenever I finish this and actually come down to the bottom, well, 480 plus 120 is 600, and 600 plus 200 is 800, which is of course the amount that we were trying to allocate. So it does look like we've at least allocated everything somewhere. Very good. Now, for my next section, then we want to look at what are called departmental income statements. So with my departmental income statements, there are a few steps that we need to look at. So the first, of course, we're going to accumulate revenues and direct expenses by department. And then, of course, we'll total those indirect expenses. We'll then allocate indirect expenses across both service and operating departments. And finally, we will allocate the service department expenses to the operating departments before preparing, in our final step here, the actual departmental income statements. So in this case, here's our step 1. So you'll notice that the way this table is set up, or the way this spreadsheet is set up, is I've got my service departments here, my general office, and my purchasing departments. And you'll notice my service departments generate $0 in sales revenue. These are simply support departments that help the other areas of my company. Next, we've got my operating departments. My operating departments are hardware sales, or hardware, housewares, and appliances. And you'll notice that for each one of these departments, they do generate an amount of sales. And that is because they are actually selling products. Now, my cost of goods sold, of course, well, $0 of that is being allocated to my service departments because they're not selling anything. And then, of course, I'm allocating my cost of goods sold, typically either based on what was sold or on a percentage of sales to my different departments that are operating departments. But you'll notice then that each one of my departments does actually incur salaries. So each area will have salaries. And if I actually add the 13.3, the 82, the 15.6, the 7, and the 78, I should come back to the $51,900. And I do believe if you do that, you will in fact find that. Now we'll do the same thing here. Each department incurs some amount of depreciation, and each department is using some amount of supplies. Now, with my indirect expenses, it's a little bit more detailed than this because I will then have to actually go through that allocation procedure. So we'll notice in this case that when we actually come through and allocate out these indirect expenses, this is what we end up seeing. Now, I do believe the textbook goes through this actual allocation process and where, for example, all these numbers come from in Appendix 22A. Now, while I don't typically require you to go through the appendices, I certainly do recommend it in this case because they go through a very detailed breakdown of exactly how they get out all of these numbers. So if you want a good example of how this works, certainly flip through to the back of this chapter, Appendix 22A, and look through this. They walk you through step by step. They tell you about the different company policies and procedures and why, for example, with this rent expense, even though the general office department and the purchasing department may occupy a relatively large amount of square footage, they're receiving a very small amount of the cost, and it's because they're located at the back of the store, which typically is worth less than that prime real estate at the front of the store. And so they give you all of those policies and things in the back of this chapter in Appendix 22A. Certainly worth a look in the textbook. I don't believe they give you that same level of detail here in the PowerPoint, so I'm not going to go through it in the PowerPoint, but it is certainly worth taking 5-10 minutes looking through how these numbers come about. And then if you have any questions, just let me know. We'll work through it in my office. We'll work through it online. We'll figure it out. But I certainly do think that is an appendix worth your time. So I try not to push you into those unless it's really helpful. And in this case, I do believe Appendix 22A will really help you start to tie this together. Very good. Now, for my next area, we will notice that my general office department has some amount of indirect expenses from these service departments and my purchasing department. Now, in truth, it is possible that my purchasing department is using something from my general office department and my general office department is using something from my purchasing department. But under my general model of expense allocation, we're allocating these full amounts out to those operating departments and not to each other. So if we wanted to allocate to each other, then we would have a step down method of cost allocation, which is a little bit more involved, a little bit trickier. And because of that, we're going to leave that off until you get to cost accounting in the next course. Certainly nothing we can't handle, but for an intro class, it's just a little bit past where we really want to go. So that's essentially what is happening here in steps 2 and 3. And now we are ready, of course, to prepare those departmental income statements. And what you will notice then is that in each case, I'm actually coming down and I'm preparing essentially a general income statement. I'm just breaking this out by department. So if we actually flip back, of course, what we would find, for example, in my hardware department, here's $119,500 in sales, $73,800 in cost of goods sold, coming all the way down, and we see these various things, $119,500, $73,800. We're just pulling all of that together from those previous slides into our income statements. Now, at this point, we're able to see my total operating income or loss for each department, and I see right away that my appliances department is actually negative in this case. So we have a negative operating income from my appliance department, and you start seeing light bulbs go off in your head, and you say, wait a minute, if that department is negative on income, should we consider that department for elimination? And I say maybe, right? Maybe it should be eliminated, maybe it shouldn't. So let's see how we might be able to figure this out. Or if there's maybe some stuff that's a little less obvious, but equally as important to consider. And this is where we talk about what is called departmental contribution to overhead. Now, the way this works is we take the amount of revenue generated by each department minus the, notice, direct expenses. Those expenses that can be directly traced to that individual department. Once I've done that, that gives me what is called departmental contribution to overhead. All those indirect expenses that can't be directly tied but are related to production, right? Remember, that's overhead. So we're trying to figure out, well, how much are we generating from this department to help cover overhead? So this is used, of course, to evaluate departmental performance. And you'll notice the key benefit here. Notice, I'm just going to highlight this because that is how important this is. This is not a function of those arbitrary allocations of the indirect expenses. And the reason this is so important is it possible that my allocation of indirect expenses was wrong? Well, of course it is, at least to some extent, right? I'm not saying it's totally wrong, and it's a completely garbage allocation. It may not be, but you'll remember that that was a fairly small loss by that department. Is it possible that I could have misallocated $500 of expense somewhere in that process? Well, sure. And so what we might see is that if I had a bad cost allocation, it could actually lead me to eliminate a department that is otherwise helping me cover my overhead. So our rule here that we need to know in this chapter that is so important is that a department may be a candidate for elimination, right? So this is when we might really want to consider eliminating that department when the departmental contribution to overhead is negative. At that point, and only at that point, should the thought, should I eliminate this area of my company, really be considered. Until that happens, this department is helping to cover overhead. So let's go ahead and look at how this works. Well, in this case, you'll notice that when I actually break this out into departmental contribution to overhead, that appliance department is generating $9,500 toward that overhead. So what we're seeing then is that even though in the end, we have negative operating income from my appliance department, if I were to eliminate this department, I would actually increase the amount of my loss by the amount of that departmental contribution to overhead. because I would no longer be generating that to cover those costs. And of course, those indirect costs then would just be allocated across the remaining two departments. So I would be giving up all of this departmental contribution to overhead, resulting in an increased loss by eliminating a non-profitable area of my organization. So it's something that's a little bit difficult to see, but it makes a lot of sense when you really think it out. Now, in our next section, we want to look at our investment center managers, and these are of course evaluated using performance measures that will combine income and those assets. So here we're going to see a lot of investment measures that we've seen some of them before, we haven't seen others. So we'll kind of walk through these one at a time. So the very first one then is what is called my return on investment. So you've heard of this almost no doubt, and just as you've existed in the business world, as you started maybe reading journal articles, maybe as you started looking at buying stocks of your own or investing in companies, the ROI of an organization is something we hear about all the time, but you may not have ever really realized what that is. So the return on investment, or my ROI, can be calculated by taking my investment center income divided by my investment center average invested assets. So of course, just as we do with any average, if I want to take the average, I simply take beginning plus ending divided by 2, and I'll divide that, of course, into the amount of income generated by that center. Well, in this case, we see we got our two areas. We've got the LCD division and my S-phone division. You'll notice that LCD is actually generating a higher amount of investment center net income. So you might be tempted to think that is the better run department, but you'll also notice that they generated an extra $650,000 worth of sales and only have an extra $100,000 worth of income, right? About $110,000 worth of income. So for that extra sales, I'm not getting nearly the return that I am in my S-phone division. And we can actually see this when we actually calculate this out. My LCD division then is coming out to an ROI of only 21%, while I've got a 23% return on investment from my S-phone division, telling me if I actually wanted to model one of these departments after the other, I would want to look at what the S-phone division is doing, how they're managing this extra efficiency, and try to build in those efficient items or those efficient processes into this LCD department to try to bump up my return on investment to that 23%. Now, in this case, we'll notice that once again, LCD earned more dollars of income, but was less efficient, right? So just what we said, than that S-phone division. Now, my next area that we want to look at is what is called my residual income. So this is one that you may not have heard of unless you're really big into investing, really big into digging through financial statements, which, you know, not a whole lot of people are. But in this case, what we're looking at is really something that our internal management team tends to actually know. This is typically not always publicized information, but this is something that we can certainly calculate on an internal level. So this is my investment center net income minus that target investment center net income. So in this case, we're assuming that the average net income that we aim for using my divisional assets is 8%. So if my target net income that I want from my organization is 8% of divisional assets, anything earned beyond that is excess, or is left over, or is residual, right? So that's where this name comes from, is that remaining piece beyond what was targeted or beyond what was expected. So similar back in 2301 when we talked about a residual value for an asset at the end of its life, that was what was left over. Well, the same thing is true here. I first cover what I needed, what that target was, that 8%. Anything in excess of that is residual. So let's see how this works. In this case, if we were to flip back, you would remember that my LCD division had $2.5 million in average invested assets, while my S-phone division had $1,850,000. Well, 8% of 2.5 million is $200,000, and 8% of 1,850,000 is $148,000, showing me that my LCD division is actually generating a higher amount of residual income than my S-phone division, right? So it's just a different measure, right? Now, this one is a little bit less helpful sometimes because it doesn't scale as well whenever we have dramatically different amounts of assets, right? So certainly we can see that it is attempting to take that into consideration, but it doesn't do it as well as some of our other methods at times. So it is a good method. It is something worth using, at least on an internal level, but it may not always give me the best information. Very good. Now, for my next area, we want to look at what is called profit margin and, of course, investment turnover. Now, in truth, return on investment that we saw earlier, so we actually flip back, we can see that one more time. I'll start back up on the screen. My ROI was taken as my investment center income divided by an investment center average invested assets, right? Certainly an important formula you want to know. Well, here we can actually rewrite ROI as a function of profit margin and turnovers. So my profit margin then is investment center income divided by investment center sales. So how much profit am I making on each dollar of sales times my investment turnover, which is investment center sales divided by investment center average assets. And so if you actually look at how this math works out, essentially what we're doing in the end, I'm canceling out my investment center sales, and I'm essentially taking at the end investment center income divided by investment center average assets, which you'll notice is the same formula we saw earlier, simply being rewritten here so that we can break this out into its various component units. So when I actually look at this in total, right, as it is actually meant to be calculated, then what I notice is my profit margin is, of course, telling me essentially how efficient I am being with each dollar of sales. So whenever I make a sale and I generate $1 of sales, well, how much of that actually turns into income, right? Certainly very important information we need. And of course, on the other side is telling me, well, all right, I've got this amount of sales, but now I've got this amount of assets. So if I'm not getting an efficient use of my assets, this will certainly point that out for me very quickly. Now, when I multiply those together, as we said, we just come back to regular ROI. But it's this split, this bifurcation that is so powerful to help management determine where the problem is. Is the problem perhaps that I'm not generating enough sales, for example, on one hand, or is it that even when I'm generating sales, I'm just not using my assets efficiently, and that is resulting in this low ROI? Very good. So in this case, you can notice that we've got Media Network and Parks and Resorts, both with about $20 million in sales. But you'll notice then that Media Network has $6,900 in income versus only $3,800 in Parks and Resorts, with slightly more average invested assets than we had for that park and resort. Now, when we actually come down, you'll notice then that my ROI for Media Network is significantly, right, about 50% higher, in fact, more than 50% higher than it is for my Parks and Resorts. And you can notice why. So that's what this slide is trying to emphasize, right? In total, my investment turnover, roughly the same. But you can see there's a dramatic difference in profit margin. So this is the power of this bifurcation. This would allow my Parks and Resorts department or my Parks and Resorts organization to look and figure out that I've got to do one of two things. I've either got to increase my income, right, on a percentage of sales, or I would need to be more efficient with those sales, right? So it's not that I necessarily want to make less sales. What I'm really after here is to try to increase this investment center income, which pushes me back, for example, to either looking at how can I generate more revenue or how can I cut cost, right? I can tell them that it's not a function in this case, very much so at least, of having too many assets, right? Certainly this is slightly less than what we have for Media Network. This 0.64 is slightly lower than the 0.72, but it's not so much different that if this were close, we would have this huge difference that we're seeing down here on ROI. Very good. Now, as we continue moving through this, then we will look at what is called the balanced scorecard. Now, this is becoming more and more popular as we progress through time. You'll know very well then that in the past, say 50, 75 years ago, by far the number one metric we used to evaluate organizations for success was this last area, was this financial metric. And I'm not telling you it's not important anymore. Financial is certainly the big one that comes to mind, that we see top of mind all the time, right? That is still true. You cannot run an effective organization if you're not generating net income. You cannot generate net income if you don't have good ROI, if you don't have sales growth, if you don't have enough cash flow to pay your employees, if you're not keeping that stock price up and vibrant, right? It's very difficult to run a successful organization without that financial picture, without that financial metric being met. That is certainly still true today, just as true as it was before. But what we're noticing now is that there might be other pieces of an organization that actually matter too. It may not just be financial, which is what we thought in the past. What we're noticing now is there are some other areas that actually matter. So, for example, my customers, they matter. So, I need to actually look at what they're telling me. Are my customers satisfied with the job I'm doing? This is why you might be asked to complete a survey. This is why companies might say, hey, how do we do? Follow us on social media and tell us how we did, right? Tell us what we can do to improve, because we recognize that this customer satisfaction is key. Because if you are not satisfied and there becomes someone else who offers a similar product, you'll simply switch over. But if you feel valued, if you feel like my organization actually cares about you, then you're much more likely to stay with me because you know that I'm meeting those needs. Now, of course, we might also want to look at things like how many new customers are coming in. How many deliveries am I having on time? Because here's the deal, even if you love my product, if you need it today and it doesn't arrive for 3 months, you're probably not buying my product again. You're going to find someone who can be reliable, right? The same thing happens from a company's perspective, right? If I'm looking at potential employees and I've got one employee that does a perfect job all of the time, but only shows up 10% of the days, or I've got someone else that does the perfect job, say 75% of the time, but shows up reliably and is putting in effort and is getting better, I can tell you which employee that company is going to go with every single time, because we have to be able to depend on you to show up, to get the work done reliably. Even if it means we have a few more mistakes with the second employee, if you're working, you're improving, you're coming in all the time, you're putting in that work, I will take that employee every day over somebody who does a much better job, but I can't rely on. And so we see that. Now, we might want to see, right? How are my new product lines doing? Are they generating a sufficient return? I tried this new idea. Did it work? If it didn't work, my customers are telling me either maybe I didn't advertise it well enough, maybe they just weren't aware of this new product. So maybe I can boost advertising and try to actually pull those sales in anyway. Or maybe they just don't like it. Maybe the market's either not ready for that product yet, or they just don't agree with it, right? Whatever the case is, I've got to look at that feedback I'm getting from my customers. And so we can continue down, but certainly anything like that is related to that customer view on my balanced scorecard. Now, internal processes, these tend to focus on things like defect rates. So how many of my products are defective? So if I'm a car manufacturer in this case, and I produce 100 cars, how many of those are having to be reworked? How many of those are actually going to hurt my customer, right? Let's imagine, for example, not a car manufacturer, but let's say we package parachutes is what our company does. And I start selling these parachutes to skydiving companies in the military. How many of those parachutes aren't going to deploy, right? Hopefully zero, right? Because if any of those parachutes do not deploy, then I'm going to have a huge problem on my hands. So we've got to look at these defect rates and really zone in on them. And certainly different areas can tolerate different levels of defects. But in certain industries, one defect is too many. And so we have to make sure we have really good internal controls in place, really good appraisal, really good training for my employees, making sure that we're able to tie all of this together to actually produce a good product that is not defective. We might be looking at things like cycle time. So how long does it take me to go from the beginning of my production process through to the end? How long does it take, or how much cost is there in actually producing this? How efficiently can I produce this product? So can I get this product to take me from 10 hours in direct labor per order down to 9.5, right? That can be a huge savings. You say, well, it's only 30 minutes. Yes, but it's 30 minutes on every single product. If I produce a tremendous number of products, that 30 minutes really becomes a huge savings. We might then look at things like numbers of days without an accident. I know growing up, my dad worked in a huge manufacturing facility and they had a scorecard, right? And it said 38 days without an accident, 108 days without an accident, whatever it was, because they took that very, very seriously. That if working with these huge machines, somebody got hurt, it typically wasn't a small injury. It was someone losing an arm, for example, right? This is a big deal. Well, in those types of situations, we have to really be careful and really be cognizant that people are doing all of the safety protocols correctly so that nobody's getting hurt, right? So having that top of mind where you walk in every day and you see that number, right? It becomes a game with yourself, a competition within your department to get that number as high as possible. One, because people are inherently competitive, but two, because you know that when there's an error, when there is a problem in this industry, for example, someone could really be getting hurt. So we want to make sure that we're not having that happen. Now, my next area and the last area that we'll look at here is called innovation and learning. This tends to be dealing with that internal side. So we looked at the customers second, right? Well, here we're going to look internally. So if the customers are more the external, right? How are we taking care of the people outside of the company? My innovation and learning tends to be, well, how do I take care of my people inside the company? So this is things like employee satisfaction. So you'll notice not only is customer satisfaction important, but so is employee satisfaction. You mean I can't run my employees into the ground? You mean I can't mistreat them, right? You mean I have to actually treat them like human beings and try to generate a good environment for my employees to work? Of course, right? We're seeing this come out now. There was recently some very bad press for one of the large finance companies because they've been treating their employees in a way that doesn't align with this high employee satisfaction. And now it's coming out and it's really dinging them publicly. It's hurting their image, right? I'm not going to mention them here, but you can certainly look this up and you can certainly find out which company this is, right? It doesn't take very much looking around. And you can notice that because at some point the employees push back, well, now there's a bad look for the organization. And now customers are starting to get a little bit antsy and it becomes a really big problem, right? So employee satisfaction is super, super big. Now, this doesn't have to be anything over the top that you have to do to keep your employees satisfied, right? But you've got to do something for them, right? If you're going to work them, say 100 hours a week for certain parts of the year, let them take Fridays off the rest of the year, right? But if you're going to take in one area, you've got to give somewhere else. Otherwise, you're going to lead to burnout and you're going to end up having to train new employees and it becomes this huge vicious cycle, right? And so we certainly don't want to see that. Right, so employee satisfaction is fairly easy to do if you just remember that you're actually dealing with people, right? And people have wants and needs. And so if we're going to ask you to give up one portion of your year, for example, then we should be willing to trade off at some point in the year to let you have that life back, to let you feel like you've got that balance. Because people, right, we don't exist for our jobs, right? We exist to live our lives. Our jobs are a mere part of our lives, right? Not that it's not important. Our jobs certainly are. But if you treat your employees like they only exist for their work, then they won't exist at your company very long, right? They're going to look for somewhere else where they feel like they have more options, where they can actually do the things they want to do. So you have to be very careful with this employee satisfaction. This is also looking at things like employee turnover, right? If I keep my employees satisfied, I'll typically have a lower turnover rate. But if I have dissatisfied employees, I'll typically have higher turnover. And this is because my employees don't feel valued or challenged, or they don't feel like they're actually in an organization that cares about them, they'll go somewhere else, right? And of course, we know that high levels of employee turnover have many effects. One of them is, of course, that higher unemployment tax we discussed back in 2301. We'll also see things like more inefficiency, because now I'm having to train new people who are not as efficient as people who have been here before. And so it can turn into a very difficult cycle. Now, of course, the amount of money that we spend on training, certainly part of this learning aspect, very, very important. That we train our employees well, that they know what's expected of them, and they know how to get that done. Of course, our numbers of new products, patents, and research, all of that is part of that innovation piece, but very, very important as well. Now, this is more important in certain industries than others, right? If I'm in a highly technological field, innovation is probably the most important of these areas, because if I'm not on that cutting edge, I'm not going to be able to be financially successful. I'm not going to be satisfying my customers, right? It's going to lead to a very vicious spiral downward if I'm not on that top edge of that innovation, right? In certain industries, this may not be as big a deal, right? If I'm in an industry that's very stable, we make some very small product improvements every year and then put it back out again, then the innovation side is still important, but certainly not as much as if I'm making some fancy microchip that goes in all the laptops and computers around the world, right? I'm going to want that microchip to be as fast as possible, to be as small as possible, to be as efficient, and to be as durable as possible, right? I'm going to want all those things because constantly other companies are popping up making this same item, and it becomes very difficult if I'm not constantly on that front edge. Now, the next area that we want to look at is transfer pricing. This is one of the very last topics in this chapter. So this is the price that is charged internally within an organization when I move from one department to another. So you'll notice in this case, I have the LCD division moving through to my S-phone division with these LCD displays. So in my LCD division, we'll notice they have production capacity here of 100,000 units. They can sell this product to outside consumers at $80. It costs them $40 in variable manufacturing costs per unit, and their fixed manufacturing is $2 million. So the question here essentially is, well, what price can I actually move this between departments? And the answer is it really depends. If I'm operating at maximum capacity and I have no additional capacity, then the only price I would be willing to accept as the manager of the transfer or of that LCD division is $80 per unit. Because if I have customer orders for 100,000 units and I can produce 100,000 units, why would I sell it to one department at $40, for example, when I could turn around and sell it at $80 to another customer? So in that case, if the S-phone division wants these units, they're going to have to buy them at full market price from my first division. But at the same time, will my S-phone division ever be willing to pay more than $80? And the answer is no. Right? If you were going to do that to me, I'll just wait until you put it on the market and buy it off the market. So we can see then the price will never go above $80. But it might come below $80 if, for example, I have production capacity of 100,000 units, but I've only got customer orders of 70,000 units. Well, this would give me a gap of 30,000 units. On that 30,000 unit gap, my manager of the LCD division will be willing to sell at a price starting at $40. Right? I will never sell at something less than variable cost, because to produce and sell at something less than variable cost would guarantee that I'm losing money for my department. I don't want to do that. But at the same time, I might not insist so hard on that $80 price, because they may well know in that S-phone division I'm not at full capacity. So we can actually negotiate a price beginning at 40 and capping out at 80, and somewhere in the middle, we may find that transfer price. Now, it may not be exactly in the middle. It might not be $60, for example. It might be 52 or 68, right? But it will likely be somewhere between 40 and 80. Very good. Now, my last piece in this chapter then is this idea of the cash conversion cycle. Now, the cash conversion cycle, if I actually have you calculate this, is one of our more involved formulas because it involves three formulas itself. So this is my days sales and accounts receivable. So once I've made the sale, how long does it take to receive the cash? Assuming the sale, of course, was on account, right? If it was a cash sale, well, this is zero because I got the cash right away. But typically, we will have some sales occur on account, so I'll need to figure out that piece, plus my days sales and inventory. So how long did it sell on the shelf before the sale? Minus my days sales and accounts payable. So this is, of course, how long does it take me to pay my bills? Well, once I net all of this out, this will tell me how long it takes me to go from buying my supplies on account to actually having that item sitting in inventory and then being sold and collecting the cash. So in this case, my day sales and accounts receivable is accounts receivable, notice net. So net all those allowance accounts and everything back from 2301 divided by net sales times 365, plus my day sales and inventory. So inventory divided by cost of goods sold times 365, minus my day sales and accounts payable. So accounts payable over cost of goods sold times 365, or this could also be called days payables outstanding. Now you'll notice something very important that is common between all three of these. In each one of these, we are in fact multiplying by 365, and that is because of the key word in each of these, which is days. So anytime we see the word days, remember we want to think multiply by 365. And of course, that is once again what we're seeing on this slide. Now, a very important point here is this can actually go negative, right? If I collect my receivables very quickly, I sell my inventory very quickly, and I negotiate very favorable terms with my suppliers, I can actually turn this into a negative number, meaning that I actually buy my supplies, produce the item, sell the item, collect the cash, and then pay my supplier with the cash from the sale, right? That's a very favorable situation. Typically, this is positive, right? Meaning that I actually have to pay before I collect all of the cash, but this can be negative if we're able to get the favorable terms that we want. Now, once again, here we see this actually worked out, and we can see that over my 2-year period, in 2016, this cycle took me 8 days. In 2017, this now takes me 10 days. And so we say, well, what is happening here? What is the driving force here? Well, you can notice, right, in each one of these, we had quite a significant change. In 2016, it took me 30 days to collect my accounts receivable, now up to 33. So let's assume I still give my customers 30 days to pay. This means more of my customers are not paying now, right? It's taking them longer. They're getting into that default section or that past due area. And so this could start to make me wonder if maybe I'm generating sales, but they're to bad customers, right? People who don't have the ability to actually pay me. When I dig deeper into this to see, well, am I boosting sales by selling to poor credit customers? I might think maybe that doesn't make as much sense because we actually now have less sales in 2017 than we did in 2016. So maybe that theory doesn't hold as much weight in this case, but it is certainly something I would typically want to look at if I noticed my day sales and accounts receivable kept creeping up on me year over year. Now, for my next piece, we'll notice that my inventory at the end of the year in 2017 was a bit higher, right? About 5% higher, I believe, if we actually do the math on this, in 2017 and 2016. And what we'll notice then is I actually generated a lower amount in cost of goods sold. So this is an unfavorable situation for me because I now have more items left in the inventory at the end of the year, and I actually sold less items over the year. So this is my big issue, is this 6-day change here. This is the one really driving this 25% increase in my cash conversion cycle. Now, when we look at my next piece, we'll notice that my days payable, or my day sales and accounts payable, were actually coming through quite nicely in this case, but we're able to push that out quite a bit further. You'll notice at the end of the year, I've got a significantly larger amount in accounts payable than I did in the last year. And that is, of course, also over a smaller balance in cost of goods sold. So we're getting a much better number in this case. So 33 plus 54, of course, is 87. 87 minus 77 is 10. 30 plus 48 is 78. Minus 70 is 8. And so we can certainly see how these calculations are working to pull all this information together for me. And this is, of course, what we are seeing. Now, at this point, this is where the textbook then comes through and actually starts to allocate out all of those different costs that we saw back in Exhibit 22.10. This is Exhibit 22A, or Appendix 22A, which is what we referenced earlier. I certainly think it's worth reading through these pages in the textbook. I'm not going to go into them here because we don't have all that supporting information that you can certainly read through in the textbook. Now, 22B is just a more in-depth discussion on transfer pricing, but it's really the discussion that we had earlier. Of course, if I'm actually dealing with a situation where I am not at full capacity, then I might be willing to accept a lower price as my manager of the LCD department, but I certainly won't go below variable cost. To sell below variable cost will hurt my department, so I will not do that. But the SFON manager, of course, won't pay more than $80 at any point in time ever, because that is the actual market price of this item. So we know we're going to end up somewhere between 40 and 80. If I'm at maximum capacity already in my LCD division, I will insist on that $80 transfer price, and my SFON manager will just have to pay back. If I'm not at maximum capacity, until I get to maximum capacity, I can operate at this in-between price between variable cost and the market price. Very good. And of course, that's all this is telling me. Very good. And so with that, we will now leave it here. I'm not going to get into the allocation of joint costs across products that is covered in Appendix C. If you want to go into that because you're an accounting major, this stuff really interests you, certainly feel free. But I do believe it is beyond the scope of what we need here in Chapter 22. So with that, we are officially done with our lecture on Chapter 22. So good luck as you get ready for this third exam, and we will see y'all next time. Thank you very much.